Accurately calculating intrinsic value is a key tool in the toolkit for any good investor. Are you fundamentally buying a stock for significantly less than it's worth and getting a really good deal? Or are you overpaying for the cash flows that a company is likely to produce for you in the future, potentially increasing your risk of a poor return or even a permanent loss? If you overpay for even a really good business, the company has to achieve increasingly heroic performance in order to provide you, the investor, a good return. And on the flip side, if you can buy a significantly undervalued company, even if that business stumbles a little bit, you can still generate a good return as an investor. The two most popular videos on this YouTube channel by far and away are both about how to calculate intrinsic value. And although the core method that I still use today hasn't changed that much since making those videos over 3 years ago, I have made some refinements to my process. So in this video, I want to share the way that I currently calculate the intrinsic value of a company. And if you enjoyed today's video and haven't subscribed to the Investing with Tom YouTube channel already, please be sure to do so. Calculating intrinsic value is both part art and part science. The value of any business is directly related to the amount of cash that it will go on to produce throughout its lifetime. So by default, we're going to have to make some estimates about how much cash a business can produce during its lifetime. And although anyone can plug numbers into a spreadsheet and get an answer, it's really important that you only do this for businesses that you understand well and that have growing, relatively stable and predictable cash flows. And our goal here is to be approximately right rather than precisely wrong. Two people can come up with quite different valuations for even the exact same company. You and a friend might value one specific company. You might come up with an intrinsic value of $100 a share, and your friend might come up with an intrinsic value of $120 per share. Now, what's really important here is that if the market price of that company is $300 a share, you're probably not going to be that interested. Yet if the market price of that company is $50 per share, it's definitely going to warrant a much closer look. When long-term value investors like Warren Buffett or Charlie Munger invest in a company, they're not looking to buy $1 of value for 98 cents. They're looking for a big discount to intrinsic value and a big margin of safety. Now, the method I'm going to share in this video is a slightly modified version of a method that I first picked up from the book The Dundo Investor by Mohnish Pabrai. I've been using it for several years at this point and it served me pretty well, and I'm going to use an example real-life company in this video as well, just to mix it up a little bit from using Apple all the time like I have done in some previous videos. I'm going to use Google as an example for this particular valuation example, and just keep in mind this really is just for example purposes. Don't take the valuation that kind of comes out the bottom here for Google as a recommendation to invest in Google or not. It really is just for example and educational purposes. So without further ado, let's jump over to the computer and start walking through this process. Okay, so we're over at the computer now, and like I mentioned earlier, the method I'm going to be using here is from Mohnish Pabrai's The Dundo Investor. Now, this isn't some sort of proprietary valuation technique that Mohnish came up with. It's a relatively simple discounted cash flow. Basically, all we're going to be really trying to do here in essence is project out the cash we expect a business might throw off in the future, and we're going to use those future cash flows to work backwards and figure out a reasonably intelligent price to pay for the business or for the company's shares today. So I've set up an Excel template to walk through that process here, and essentially the data input is basically just going to be in the gray sections here. So firstly, I've just typed in Google, G-O-O-G-L as the stock we're going to be looking at. There's some nice Excel plugins now where we can get some stock data flowing through. If I change this to Apple, for example, AAPL, then I would get some stock price information for Apple coming through. But we're looking at Google for this video, so GOOGL is our stock ticker. That'll bring us through some recent market prices as a bit of a reference. But our first bit of data input, and arguably the most important bit of data input here, is going to be basically how fast do we think Google can grow their cash flows out into the future. Now, there's a few ways we can do this. For this particular video, I'm going to jump across to Yahoo Finance and grab some of the numbers around what analysts expect Google's growth to be. This can be a combination of maybe analyst expectations combined with your own research. I would tend to err more on the side of your own research if you're going to have some confidence confidence in some of the values. But nonetheless, just for example purposes in this video, I'm going to go to Yahoo Finance where I've pulled up Google. Under the analysis tab here, we can scroll down and we can get some estimates on potential future growth for Google. And we can see that analysts expect Google over the next 5 years to grow at 16.2% per annum. So let's plug that in just as a starting point for this video, 16.2%. We're then going to have to estimate how much we think Google can grow in years 6 to 10. This is going to be a sort of 10-year discounted cash flow we're going to go through. I tend to try and be more conservative with the really far out growth rates compared to the closer in time growth rates. We just don't really know with a lot of confidence what's going to be happening in 5 years, let alone in 10 years. So I'm going to dial it back a little bit, and let's just say for argument's sake, I think Google can grow at 10% per year for years 6 to 10 in our discounted cash flow. Now the next input here is the discount rate. Now the value of any business is really the sum of its future cash flows discounted back at an appropriate rate to today. And if you don't really understand what the discounting part of that business valuation sentence kind of means, think about it this way. If I offered you $1 today or $1 10 years in the future, which would you rather have? And most people would say, well, I'll take the $1 today. There's no advantage really in me waiting 10 years to just get the same amount of money I can get right now. But if I were to change that equation somewhat and say, if I were to offer you $1 today or $1 billion in 10 years, then it starts to make a whole lot of sense to wait around 10 years and take the $1 billion rather than just taking $1 today. So somewhere between $1 and $1 billion, there's kind of a magic number for each person to where it starts to make sense to wait around for 10 years as opposed to just take the cash today. And that's really what discounting future cash flows is all about. We're trying to put in some reasonable rate of interest that warrants us giving away cash today to wait to get more cash back in future. So I'm going to use a 10% discount rate for this example. It's the discount rate Monish Prabrai uses in his book. It's the discount rate I use personally for most companies. You could go to countless business school lectures that will talk through various really complicated ways to calculate the exact discount rate you should use for all sorts of different companies. But for simplicity, in this video, I'm just going to use 10%. And just as a bit of a visual representation of what discounting cash flows actually does, this graph here shows the present value, so the value today of $1 of annual cash flows discounted back at 10%. And you'll see, just as an example, that $1 produced in 10 years is only worth about 39 cents to us today using a 10% discount rate. Okay, jumping back to our discounted cash flow, our next input here is a terminal value multiple of free cash flow. Now, during this exercise, we're basically going to project out some free cash flows, and then we're going to theoretically sell the business in 10 years and also get some cash flow from that. And this terminal value multiple is basically what multiple of cash flow might we be able to sell our business for in 10 years' time. Again, I'm going to use Monish Prabrai's guidelines here. He recommends a range between 10 and 15, 10 for poorer quality businesses, up to 15 for higher quality businesses. With a company like Google, I'm going to go for 15. Again, you could attend countless business school lectures going through how to calculate the exact correct terminal value, but we're trying to be approximately right here rather than precisely wrong. Like I said at the start of the video, we're trying to be directionally correct, so I'm just going to use 15 in this case for Google. Now for our last few inputs here, it really is just a case of kind of plugging in some of the numbers. Firstly, we've got our free cash flow. This is year zero free cash flow. So it's sort of the starting point from which we will model some growth out into the future using our 16% and 10% growth rates. Again, I'm just going to go back to Yahoo Finance and look for the current free cash flow of Google. I can do that by going to the Financials tab, and I should say that although Yahoo Finance is quite quite good. It's not always perfect in terms of getting completely accurate data flowing through. There are some paid tools that I will leave links for in the description that do have a little better quality data from my experience at least. And the gold standard, of course, is always going directly to company reports. So you can just search up sort of company name, investor relations, and see the actual audited financial statements for companies if you want really the best and most reliable data. Nonetheless, let's go to the cash flow statement here in Yahoo Finance for Google. And if I scroll down, we will see that free cash flow for the last 12 months was $60.01 billion at Google. Now, what I really want to do here is make sure I pick a fairly representative year for free cash flow. Free cash flow can be quite a lumpy number, so you want to make sure that the year you pick based off your research is reasonably representative of sort of a typical year at that company. For argument's sake for this video, let's go with that 60.01 billion. We'll come through and type that into our spreadsheet here. Next up, we've got stock-based compensation. So if I go back to Yahoo Finance, that is again going to be part of the cash flow statement here. If I break out operating cash flow and then our next section here, I will see a stock-based compensation expense of 19.362 billion. Now, stock-based compensation is not a cost that's captured in our free cash flow number, but it is a very real expense for shareholders. Stock-based compensation basically is the company issuing shares to employees as part of their compensation packages. And the more stock-based compensation that a company does, the more pieces of the pie or shares of the company there are, and the more that long-term everyday investors get diluted over time. So it is a very real cost, and that's something that I've added to my discounted cash flows over the past couple of years. So I'm going to add that 19.362 billion here into our spreadsheet. Net cash or net debt. Now, when we invest in a company, we of course get the cash producing engine and the assets of the business, but we also get their balance sheet. So we get any debt that the company has and we get any cash that the company has. So if we jump back to Yahoo Finance, we can grab the necessary numbers to do an adjustment for that cash and that debt. If I go to statistics here and scroll down, I will see on the balance sheet section that Google currently has $115.1 billion in cash versus $29.49 billion in debt. So if I go back to my spreadsheet here, I can type in 115.1 billion in cash minus the 29.49 billion in debt. Gives me net cash of 85.6 billion. Now, if a company had more debt than cash, that would be a negative number. That's completely fine, but Google has a lot of cash lying around. And finally, shares outstanding. Now, if I jump back to Yahoo Finance, in the share statistics section here, we should have a shares outstanding figure. And this is a good example of where from time to time, Yahoo Finance can get things wrong. Now, I've been following Google for some time, and I happen to know that they have a number of different share classes outstanding, which make it a little more complicated than most companies to work out the total number of shares outstanding, and this number is actually incorrect. So just double check your numbers when you're doing these valuations. If you get a valuation result that just seems wildly wrong, it probably is, and you will want to check your assumptions. So before this video, I've gone to the Google investor relations page, opened up a recent report and checked the number of actual shares outstanding at Google. And I know that that number is in fact 12.609 billion shares outstanding. And those are all the inputs required to do our discounted cash flow here. So we now have $47 billion of free cash flow less the stock-based compensation in year one. That is our 60 billion minus 19, and then it's growing it, our 16%. That free cash flow grows at our 16% out to year 5 here. We then have the growth still continue, but at a slower rate at 10% out into year 10, where we then have a big second cash flow event in year 10, which is our 15 times sort of terminal value multiple, as if we were to sell the business in year 10. Those numbers we of course need to discount at that 10% rate like I talked through earlier. So that's what this present value column is. It's showing some much more modest figures in here because we've discounted it at 10% annually. And if we tally all those up, we get about $1.3 trillion here for Google. That 1.3 trillion is the present value of future cash flows based on these assumptions, but Google also has that, $85 billion or so of cash lying around, which we also get when we buy the stock, or we get a proportion of it. That takes us to $1.395 trillion. We divide that by the number of shares outstanding, and we get an intrinsic value of $111 per share. Now, unfortunately for us, the current share price of Google is $129 as of recording the video, which is above the intrinsic value. So we unfortunately have a negative margin of safety at the moment. It's looking modestly overvalued using these assumptions, but it does lay out some nice sort of target margin of safety prices for us here as well. As investors, we want to try as much as possible to buy with a big discount to intrinsic value. Probably at least 20 or 30% is what most investors would target. Phil Town in his books has written pretty extensively about targeting a 50% margin of safety. And although we are nowhere near some of these margin of safety prices at the moment, we can see that in the last 52 weeks, in the last year, Google has been as low as about $83 per share. So you could have had close to a 30% margin of safety had you bought at the lows. Things go wrong in investing, companies don't meet our expectations, we make mistakes as investors in our assessment of the future, and for all those reasons, we really need to demand a big margin of safety. What a lot of investors do, myself included, is set up watch lists of some of the companies that I feel like I understand and that I think have good futures. I do valuations on them, and I simply wait around for opportunities to buy with a margin of safety. If you have a big enough watch list and you are patient with your investing, those opportunities do come up from time to time. So I hope you enjoyed this updated video on how to calculate intrinsic value. If you did, be sure to drop a like on the video and also subscribe to the channel if you haven't already. If you want to download that spreadsheet template for yourself and have a play around, I will leave a link in the description for that below as well. But that's it for me for this one, and I'll see you in the next video. Cheers.